Good day, I am Dr. Suresh Rama, Head of Rates and FX Strategy at RHB Group. Today our topic is Global FX Markets eye Fed's next move. FX volatility, as reflected by Deutsche Bank's Currency Volatility Index, has been quoted below 6% as the DXY index inches higher. The gradual moves up in the DXY index instead of a sudden spike has kept hedging costs low. We believe the US Fed statements will be neutral rather than hawkish in upcoming FOMC meetings. Markets are likely to price in the impact, thus giving the DXY index an orderly ascent and keep FX volatility at bay, playing in favor of minimizing hedging cost. On the US economic indicator front, we note US consumer confidence fell to a 6-month low in August as worries about soaring COVID-19 infections and higher inflation dimmed the outlook for the economy. Consumer confidence index has dropped to a reading of 113.8 in August, the lowest since February, from 125.1 in July. The survey from the Conference Board showed consumers are less inclined to buy a home and big-ticket items like motor vehicles and major household appliances over the next 6 months, supporting the view that consumer spending will cool in the third quarter after 2 straight quarters of robust growth. On the inflation front, we note core PCE for June at 3.4%, US 10-year at 1.35%, real yields are negative and inflation is above the Fed's target. This poses a dilemma for the Fed, thus the need to look at jobs growth. We believe it is crucial for upcoming non-farm payrolls to rise to provide supporting argument for the Fed to undertake the bond taper framework. On the China front, spreads between US 10-year Treasury and China 10-year bond yield spreads has stabilized around 155 basis points and is likely to edge lower once the Fed provides the taper framework. This would flatten the spread and play in favor of the dollar. We believe the CNH will come under pressure to weaken on the back of this argument. In the Malaysian space, we note Malaysia's bond swap spread remain inverted by almost 30 basis points. The 10-year interest rate swap curve is trading around 3% while the MGS 10-year is hovering around 3.24%. The swaps market is likely to edge higher towards the bond market yield. The inversion in the 10-year bond swap spread is expected to steepen once again. Given inflationary pressures in Malaysia to stabilize, we believe the Malaysia's 10-year interest rate swap will need to price in higher interest rates. We expect CPI inflation to print around 2% year-on-year by end 2021 versus the July print of 2.2%. With the economic reopening already ongoing, chances are inflation could regain its strength and trend higher. On the currency front, dollar ringgit has breached below its 90-day moving average level of 4.1675 and retraces below 415. Technical charts suggest a deeper retrace could see the pair testing its lower Bollinger Band level of 4.0750. However, we believe the risk is still for ringgit to stabilize in the 4.2 levels in coming quarters given the dollar strength. The current undershoot in dollar ringgit is expected to provide importers a chance to buy dollars at cheap entry levels. Thank you for listening to this podcast. Have a good day and stay safe.